Airbnb shares yesterday doubled, more than doubled after their market debut. They're rising again today, by the way, but they're up just about 2% in today's session. But that gives the company a market cap of close to $90 billion. DoorDash, of course, also had a big IPO. So as we get to the end of the week here and we take a look back, I am reminded of a conversation and something that Myles has been reminding me of, and a little bit of a dispute that we had the other day where I questioned these valuations. And Myles very reasonably pointed out that a lot of these companies, their strategy is they just don't sell a lot of shares to the public. So most of the float that there is not the bulk of the company's shares outstanding. So that's something that is sort of a technical thing that can affect the demand for these shares. Myles, I mean, I guess how sustained, though, I wonder, can that effect be? At some point, I wonder, will they sell more shares to the public, and what effect will that have as we look down the line?
Yeah, I mean, look, everyone's getting very upset about this, right? And I think, and Julie, you and I talked about this. I believe it was with Peloton's IPO or direct listing. I don't even remember how Peloton came to market, but I remember writing about the idea that Bill Gurley has, which is that everyone should direct list because then you get the quote unquote real price for your shares. But and then you don't make the bankers rich, and everyone who flips the stock on the first day doesn't get to keep their money. And Bill Gurley, highly respected VC, made a lot of money, smarter than me. So who am I? This is his pet thing. This is all he talks about now every time a company comes to market. But to say that DoorDash left a bunch of money on the table because they got the stock pop on the first day. Same with Airbnb. I mean, that's just not really correct, right? The bankers went and built a book for demand, a blind book for demand for the number of shares that were being sold, which, by the way, is the company's decision because they don't want to go issue 20, 30, 40% of the float. They don't want to dilute their existing shareholder base by that amount. So what you get is an extremely popular company like Airbnb, like DoorDash, coming to market with an extremely small slice of that business available to be invested in by hungry investors who, yes, are very excited about the market, yes, want to own this name. And so we see what's happening today. And to your question about should they sell more stock? Absolutely, right? I mean, your currency is now your stock price. Mark Benioff has done that better than pretty much anybody, and Salesforce shareholders have been rewarded. So I think it raises a lot of questions about capital markets, this, that, the other. But here we are. Look, DoorDash getting right-sized in real time by the markets. A 7% knock on their future discounted cash flows. Everybody goes home happy, right?
Well, no, not everybody goes home happy because you know what? The bankers here, I do think, rig it against the average investor. You have the average investor that's on our platform. They see these stocks going through the roof on the IPO day. And you know what? They're going to get burned when an Airbnb comes out and reports a whopping loss 3 months from now. They're going to get burned when DoorDash says, you know what? We're not going to be profitable until 2025. And for the average investor, that just straight up stinks. And I think brings us back to the core notion here. The traditional banking model doesn't make sense anymore. It's broken. It continues to be weighted towards the bankers, and the average investor gets the shaft.
I do wonder how much is institutional ownership of a DoorDash and an Airbnb, and how much is individual retail investors. Hopefully, we'll get some numbers on that as things progress.